Welcome! In this explainer, we're going to turn you into a decision maker for one of the most critical topics in all of accounting, inventory. Get ready, because the choices we're about to cover, they have a massive, massive impact on a company's bottom line.
Okay, let's dive right in. It all boils down to this. A company's profit, its tax bill, and even its total value can all swing based on the answer to a single, fundamental question. And it's a question every single business with stock has to answer.
And trust me, this is so much more than just counting boxes in a storeroom. This is about putting a dollar value on your unsold goods. And that means making strategic choices. Choices with very real financial consequences.
So before we get into the how, let's talk about the why. Why is getting this right so incredibly important? Let's look at what's actually on the line when we talk about inventory accounting.
You know, you can think of inventory as the central gear in a company's financial engine. Getting it right means you can control your costs, set the right prices, and manage your cash flow effectively. Get this right, and the whole machine just runs so much more smoothly. All right, let's get to your first big decision. How closely do you need to watch your stock? This one choice completely changes how you track everything that comes in and goes out the door.
And this slide really nails the trade-off. The perpetual system on one hand is like having a live dashboard. You always know exactly what you have. It's powerful. The periodic system, on the other hand, is way cheaper and simpler, but it's kind of like being blindfolded. You only see what's really there when you stop to do a physical count.
So how do you choose? Well, it really boils down to what you're selling. If you're doing in high-value stuff like jewelry or electronics, a perpetual system is a must-have. You need to know immediately if something goes missing. But if you're selling thousands of low-value nuts and bolts, a simple periodic count at the end of the month will probably do just fine. Okay, so you've decided how you're going to track your stock. The next huge decision is, how do you value it? This is where we get into the three main methods for putting a cost on the inventory you're holding.
Let's kick things off with FIFO. The absolute best way to picture this is a conveyor belt. The very first items you bought and put on the belt, well, those are assumed to be the very first ones you sell. First in, first out.
And this table shows you the financial ripple effect, especially when prices are on the rise. With FIFO, your cost of goods sold is based on those older, cheaper prices, which, surprise, makes your profit look higher. At the same time, the inventory you have left is valued at the most recent, more expensive prices.
Next up, we have AVCO, which stands for average cost. Now, I want you to forget the conveyor belt. For this one, think of a blender. Every time you buy new stock, you toss it into the blender with the old stuff, give it a whiz, and out comes a new average cost for every single unit.
The big idea with AVCO is stability. It's designed to smooth out all those wild price swings you might see with other methods. It gives you a much more stable, moderate profit figure, and, super important, it is fully compliant with international accounting standards.
And that brings us to our final method, LIFO. The metaphor here? Imagine a stack of plates at a buffet. The last plate you put on top is always the first one somebody grabs. So, with LIFO, you assume you're selling your newest inventory first. Last in, first out. But, and this is a huge but, especially for your exams, LIFO is basically banned under IFRS, the International Financial Reporting Standards that most of the world uses. Now, it is allowed in the US under their rules, but for everyone else, it's simply not an option. Okay, time to put these methods to the test. How do they actually perform when the economy gets a little rocky and prices start to climb? Because this is where your choice really hits your profit and your tax bill. This table tells such an important story during inflation. Just look at FIFO. You're matching old, cheap costs against new, high sales prices, which makes your profit look way bigger. LIFO does the complete opposite. It matches recent high costs against sales, which means you report a lower profit. And AVCO, just like we said, it smooths things out right in the middle. And when you see it as a bar chart, it's undeniable. In a hot, inflationary market, just by choosing FIFO, a company can report a much higher profit. Now, higher profit sounds great, right? But just remember, that also means a higher tax bill. So you've picked your tracking system and your valuation method. But guess what? You're not done yet. You have to be able to prove that the numbers on your screen actually match the reality in your warehouse. And this is where the physical stock take comes in. It's a critical reality check. It's not just about counting. It's a whole process. You prepare, you execute, you reconcile what you found with what your books say, and then you adjust for any differences.
This is how you catch things like theft, damage, or just simple errors.
And there's one last fundamental rule you have to follow, straight from International Accounting Standard 2. It's called the prudence principle. It's basically a rule of cautious accounting that says you can't overstate your assets. Your inventory has to be valued at whatever is lower, its original cost or its net realizable value, which is just a fancy way of saying what you could sell it for today minus any selling costs. You always have to pick the more conservative number.
This shows you exactly how it works. If your stock is doing great and is actually worth more than you paid for it, you still have to value it at cost. But if that stock is now obsolete or damaged and is worth less than what you paid, you have no choice. You have to write its value down and recognize that loss right away. So, we end by putting you back in the driver's seat. Here's the situation. Inflation is high. You have to follow international rules, so LIFO is off the table. What do? Do you choose FIFO to report higher profits, maybe impress investors? Or do you go with AVCO for more stability? Your choice tells a very different story about your company.
So there you have it. From choosing how to track your inventory, to picking a valuation method, to finally verifying it all against reality, every single choice tells a different financial story. Understanding these trade-offs is absolutely key, not just for passing your exams, but for making truly smart business decisions. Thanks so much for joining me.